For decades, right, a massive employee headcount was literally the ultimate corporate status symbol. Think about it. If you had tens of thousands of employees sitting under your roof in giant glass skyscrapers, you were dominating the market. In the old world, headcount equaled power. Well, welcome to another Explainer. Today, we are unpacking a major structural shift in the corporate world that completely flips that old logic entirely on its head. It's rewriting the rules of institutional investing as we speak. We're looking at why Coinbase suddenly firing 700 people isn't a sign of failure, and it's not a sign of distress, but rather a highly calculated victory in what analysts are calling the new 2026 efficiency war.
Okay, so let's dive right into this. On May 5, 2026, Coinbase made an announcement that sent absolute shockwaves through the market. They declared a massive 14% workforce reduction, that is approximately 700 employees out the door. And it came accompanied by a $50 to $60 million restructuring charge just for severance. Now, normally, a massive severance charge like that spells absolute panic for investors. I mean, in the old days of the market, this kind of news would trigger a massive, immediate sell-off. But instead, Wall Street actually bought in, and Coinbase's stock immediately surged.
And honestly, if you're managing a portfolio right now, this is the exact question you need to be asking. Why did losing 700 employees cause a 6.14% stock jump? Investors didn't panic, they cheered. So what does this all mean? Well, we are going to see exactly how shrinking a corporate workforce actually acts as a massive margin expansion catalyst in the AI era. It's a fundamental pivot in how the market values human labor versus compute power. Here's a quick look at exactly how we'll break down this contrarian thesis today. We'll cover the efficiency war, the new metric of RPE, compare Coinbase directly with Wall Street, explain the 5 layers rule, look at layoffs as margin expansion, and finish up with the lean alpha checklist. Starting off with Section 1, the efficiency war. Let's talk about human capital efficiency. This is a structural pivot toward an AI-native operating model, and it's specifically designed to maximize productivity while eliminating what's known as the coordination tax of excess management. The old paradigm, as we know, was all about growth at all costs, but the new paradigm is what we call lean alpha. And think about that coordination tax for a second, because we have all experienced it. It's those endless alignment meetings, right? The syncs you have to schedule just to talk about other syncs, and the redundant approval chains required just to push a minor software update in a legacy firm. It's a heavy bureaucratic drag, and it just accumulates like plaque as a firm scales. Lean Alpha strips that out entirely, and it is the foundational blueprint for 2026's top-performing stocks. Moving to Section 2, the new metric, RPE. So the traditional math for this was pretty straightforward. Revenue divided by headcount. But compare that with the AI era math. Revenue divided by, in parentheses, headcount minus AI automations. Traditional math gave you a simple, standard revenue per employee. But institutional analysts have totally evolved this calculation. You might be wondering, why does subtracting AI automations matter so much here? Well, because treating AI as a subtracted headcount allows analysts to see the true actual leverage of the remaining human workers. They are accounting for AI integration specifically replacing traditional middle management workflows. This new metric serves as a high-fidelity proxy for how effectively a company is leveraging its internal talent against its technological infrastructure.
Now for Section 3, Coinbase versus Wall Street.
Take a look at these fiscal year 2025 headcount and RPE numbers. We've got Goldman Sachs up top at $1.23 million, Robinhood sitting at $1.1 million, JP Morgan at $572,000, Bank of America at $495,000, and way down there, Coinbase at $307,000. Let's walk through this contrast deliberately because it brilliantly illustrates the concept of corporate bloat. You have Goldman Sachs leading the pack. Robinhood, which is an AI-native upstart, is right on their heels. Then you had the legacy retail giants sitting in the mid-500,000s. Honestly, just looking at this data, to put it in perspective, it takes almost 3 JP Morgan employees to generate what one single Robinhood employee produces on an average Tuesday. But look at the bottom. Pre-restructuring, Coinbase was at a mere $307,500 RPE. They were vastly lagging behind leaner rivals. And this massive disparity right here, that was the exact catalyst for CEO Brian Armstrong's no manager mandate. Which brings us to Section 4, the 5 layers rule. So a legacy corporate pyramid usually has 12+ layers, and it relies heavily on pure managers. Compare that to the new Coinbase org chart. A maximum of 5 layers, requiring player coaches. This is how you actually dismantle that coordination tax we talked about earlier. A traditional legacy pyramid, like what you might see at a giant retail bank, often has 12 or even more layers of management. Every single one of those layers acts as a filter, distorting information and drastically slowing down decisions.
Coinbase's new mandate, however, allows a maximum of just 5 layers below the CEO and COO. The result? A massive widening of the span of control. Leaders are now expected to manage 15 or more direct reports. Now, how is that humanly possible without just burning out instantly? AI tracking agents. Dashboards now automatically summarize team outputs, they track code commits, and they highlight bottlenecks, which completely removes the need for a human pure manager whose only real job is to act as a glorified status reporter. There are no more pure managers. Every leader absolutely must be a player coach, meaning an individual contributor who gets their hands dirty shipping code or drafting strategy right alongside their team.
Another key to this is collapsing the PED triad into what they call one-person teams. The technical core enabling this super flat organization is collapsing product, engineering, and design. Traditionally, you need that entire triad to build pretty much anything. That means multiple different languages, shifting priorities across departments, and a ton of coordination. But today, a single employee using tools like GitHub Copilot and Cursor can literally handle all 3 functions. Brian Armstrong noted that engineers at Coinbase are using AI to ship in days what previously took a whole team of humans weeks to pull off. Let's just linger on that concept for a second: corporate metabolic rate. We are contrasting the slow, weeks-long, multi-departmental sprint of the past with the AI-empowered, single-day deploy of the present. The speed at which the company processes ideas into reality has fundamentally structurally multiplied.
Now check out the DHCI RSFFP hypothesis. It goes: 1. Digital human capital investment. 2. Tech resource use. 3. Org resource use. 4. Firm financial performance. I know this is a total mouthful, but let's break it down deliberately because this is actually the definitive academic proof of our thesis. Step 1. Digital human capital investment, meaning you hire AI native talent. Step 2. That naturally drives tech resource use, which is the efficient deployment of AI agents across your internal systems. Step 3. That forces organizational resource use. You actively flatten the corporate structure and improve communication flow because the AI is handling all the routine reporting, which ultimately leads us to Step 4. Firm financial performance. See, this isn't just a theory, it's a proven sequence. Investing in AI native talent and systematically flattening the organization drives undeniable, hard math margin expansion.
Section 5. Layoffs as margin expansion.
We are seeing this incredible new offensive layoff trend. Meta made 8,000 cuts to help fund $135 billion in CapEx. Snap did a 16% reduction, driving a 26% stock surge. Block cut 40% to build a mini AGI. We are witnessing the undeniable rise of the offensive layoff. Think about it. Traditionally, layoffs were defensive. They were a last resort when revenue collapsed and panic set in. But look at this trend line right now. Meta cut 8,000 jobs entirely from a position of strength to help fund a staggering $135 billion capital expenditure into AI infrastructure. Snap reduced its workforce, and the market immediately rewarded them with a massive stock surge within a week. Block cut nearly 40% of its staff just to re-architect the company. Instead of defensive panic, these are offensive, calculated maneuvers to swap human labor costs for high-density silicon and computing power. Let's give this compute for labor swap some breathing room, because it is absolutely profound. Capital expenditure on GPUs yields future scalable automation. Operating expenditure on payroll just yields more bureaucratic drag and inflation adjustments. Wall Street knows this for sure, which is exactly why they are overwhelmingly rewarding the swap.
Look at this quote: 100 people plus AI equals 1,000 people. That's from Jack Dorsey, the CEO of Block. This quote perfectly encapsulates the mindset of the modern executive. It has basically become the new mantra across Silicon Valley. It proves that workforce size, which was once the ultimate status symbol of corporate success, is now viewed by investors as a total anti-pattern. If you are evaluating a company's growth right now and their executive team gets on a call and brags about adding 2,000 new middle managers this quarter, that is no longer a green flag. It is a massive, glaring red flag. If you have too many people, you are inefficient. Period. You are slow.
Let's wrap it up with Section 6, the Lean Alpha Checklist.
Here is your 2026 investment checklist. 1. Rising RPE trendline. 2. Under 7 organizational layers. 3. Leaders as individual contributors. 4. AI native work monetization. 5. High operating leverage. Listen, if you want to find the true AI achievers in today's market, this is the exact 5-point structural filter you must apply to their SEC filings and their earnings calls. Number 1. A rising RPE trendline. Is their revenue per employee growing faster than their peers? Because if it's stagnant, they simply aren't adopting AI effectively. Number 2. Under 7 organizational layers. Are they actively flattening the hierarchy to speed up their decisions? Number 3. Leaders as individual contributors.
Have they finally eliminated the pure manager who simply forwards emails and updates spreadsheets all day? Number 4. AI native work monetization. Are they using AI to directly automate internal workflows and sustainably lower their operational costs? And number 5. High operating leverage. This one is absolutely crucial. Can they handle a sudden market downturn without desperate defensive measures? When a company minimizes its fixed human costs, it gains incredible flexibility to weather a recession without panicking.
The biggest risk now is not taking action. That's from Brian Armstrong. I'll leave you with this final thought on the absolute necessity of this painful transition. The efficiency war is already being fought right now, and the casualties will inevitably be the companies that refuse to adapt. As you look at the legacy holdings in your own portfolio today, you have to ask yourself a really serious question. Are they truly ready to compete in the no-manager economy? Or are they still paying a massive, crippling coordination tax to a middle management tier that AI has already rendered obsolete? Thank you so much for joining me for this explainer. Look closely at your holdings today and start searching for that lean alpha.